All right, ladies and gentlemen, welcome back to another YouTube video. It's your boy K Doon Trades, and in this video, it's going to be zero editing, straight raw dog educational video. We're going to be going into my trading model, breaking down exactly what it is, showing you multiple examples, and showing you how and why this actually works. Now, I have made well over six figures in prop firm payouts using this exact model, so you're going to want to stay tuned and listen to what I have to say. So let's jump into exactly what this model entails and how you're able to use it. Now, these are the three things that the mechanical model itself calls for. First things first, we have a sweep, a fake sweep, real sweep of a high or a low. Doesn't really matter what it is. A pullback to your OTE. OTE stands for your optimal trade entry, and then you can use additional confluences as well. So let's get into the mechanical model itself. And to preface this video is going to be for people that already know the basics of trading. This is not going to be a basics video. So if you already know what you're looking at on the charts, this video is perfect for you. So first things first, what do I mean by a sweep? Now, anytime we have price, let's say accumulating in a range, and we have a sweep of the low, break of the high. As you can see, we had sweep of this low, break of whatever high. That would be considered a bullish fib or a bullish leg per se. Now, when we see something like this, typically we then want to draw the fib from the manipulation of that or the break of that low, the sweep of the low. And then we would take that from either wick to wick or body to wick, depending on if it is pre-session or if it is during a trading session. Now, I don't just jump in as soon as I see some sort of inversion or anything like that. I wait for more bullish confirmation. What does that mean? I'm waiting for price to come back down into my 618 range so that it can then continue higher. Now, the way I like to look at this is the market works like a rubber band. When you pull a rubber band back on your thumb and it creates that tension and you let it go, it snaps forward. Now, you can look at the markets the same way. The market isn't going to just be going straight up or straight down. There's going to be needed to there's going to be a pullback needed for us to fill an imbalance and continue higher. Now, vice versa. If we were to be accumulating in a range here, and let's just say or accumulating, and we have a sweep of this high, a break of the low, I would then draw my fib from the leg that swept the high or the fake sweep leg, whatever you might want to call it, and then you would draw your fib out and look for your 618 entry off of the pullback. So just like the bullish fib, we wait for our pullback to continue lower. Just like I said with how the market works like a rubber band. Now, you can't just fib out every single one of these sweeps of highs or lows and expect it to play out. So, what are we looking for? What legs are we looking to get swept? What legs are we looking to anchor our Fibonacci retracement tool to? So, these are a couple of the things that I look at, and we'll go through each of these one by one. So, first things first, let's go over these extension levels. And I'm going to show you why they're so important and why they work just about every time. Now, whenever you anchor your fib on a bullish or a bearish leg, it doesn't matter what it is, you get these funky looking lines. And you're probably wondering, okay, what are these? What purpose do these lines serve? Now, typically, -1 is the spot where we're able to catch an entry if we missed our initial 618. -1 is typically our retracement level or pullback area, whatever you would like to call this. This is the area where you should see some type of pullback or reaction off of. -2 is typically a good reversal zone. -2.5, -5, or -2.5. These are also good reversal zones. As you can see, this -2.5 actually caught the bottom of this pullback right here. -4 and -4.5 is what we're really looking at. -3 is not as important. I use these levels pretty rarely, but I have them there. And then we have -4 and -4.5. These are where it gets important. -4 and -4.5 are going to be considered your max expansion. Typically, you'll see price have a reaction in the opposite direction 90% of the time that -4 gets hit if you have a proper fib in place. Now, if we're in such a strong downtrend like the one we've been seeing this last week, obviously that's probably not the bottom, but you'll be able to catch a reversal spot. As you could see, when I fibbed out the manipulation leg of London, or the first or the very last price leg before London opened, I fibbed out that range. -4.5 gives you a pretty mean long entry for right around 95 points. So this is typically where you'll see a lot of your reversals and things like that. Now that we have covered what the Fibonacci is and what these standard deviation levels mean, let's get into how I look at the charts. Basically go into as if I was trading actively, what I look for and what I do every single day. Now, your next thing is going to be your bias. Bias is typically the first thing I have in mind when I go into my trading day or trading week. Your bias is extremely important because you need to understand where price is going. You can use typically when your bias is correct, using the Fibonacci is a little bit easier in catching your entry and understanding how far price is going to go. So what do? I start on the higher time frame. I get an overall look at the direction that we are headed on the higher time frame because the market is fractal. The price does the same thing on every single time frame. It just looks different. The 4 hour is going to be the most reliable and telltale sign of where price is headed. Now, as you can see, as of recently, due to war and everything else going on, we have been in a pretty mean downtrend, and we have finally broken out of this crazy range that we've been in since about February. Now, like I said previously, how the market works is it acts like a rubber band. And what I mean by this is it happens on the weekly bias too. So anytime I have, let's say, for example, a bearish bias on the week, typically the week will play out something like this. We've got Monday, Tuesday, Wednesday, Thursday, and Friday. Typically, if I have a bearish bias, we open pretty strong. We're pretty bullish for the first half of the week. Wednesdays typically are reversal / higher probability trading day. And then we typically end the week off bearish. We're not going to just be going straight down if we have a bearish bias on the week, or if price is going to be bearish, we're not just going to be plummeting the whole time. Obviously, we're going to see pullbacks on any time frame, like the 4 hour, etc. And vice versa. If I were to have a bullish bias on the week and we have Monday, Tuesday, Wednesday, Thursday, Friday right there, typically the week looks something like this. We open up bearish, finish off the week in a bullish uptrend. Now, the thing I will say about having a weekly bias or a higher time frame bias is I would not marry your bias. Anything could happen with Trump being where we are in such a unique trading time period where price action has done some things that nobody has really ever seen in history. And with the war news, everything like that, the volatility, everything is going crazy. So it's important not to marry your bias. However, it is good to know or have in mind a direction that you would like to see the market headed based off of what you are being shown. Same thing with a daily bias. Now, the way price works is it hunts liquidity and fills imbalances. Now, what do I mean by this? If you put on the indicator ICT kill zones and pivots, this marks out each session high and low for you. What does this show you? This just shows you where session liquidity was left. Now, as you can see, we have New York PM highs here. We have New York lunch highs. We have AM highs. London. We have so much draws above us. Now, compared to below us, there's absolutely nothing since, what was it, like November of last year? that price was this low. Now, with that being said, we are in such a strong downtrend that it is going to be hard to justify taking longs unless it is an A plus setup. Now, what do I mean by price hunts liquidity and fills imbalances? Now, this works extremely well with how the Fibonacci works. As you can see, if you were to mark out a range, it gives you the 0.5 range, which is 50% of the range in which you extended your Fibonacci level. So in between 23,658 and 23,534, 50% of that range is going to be here at 23,599. Now, price leaves imbalances in the market in which price is drawn to in 50% of the range. Now, price typically has to fill imbalances to continue lower. Now, it is not always that price is going to instantly hunt an imbalance. However, the market is drawn to these specific things. Now that we've got the Fibonacci extension levels out of the way, how price works, what price is magneted to, and gone over bias, let's go over some additional confluences that I use and that I look for to enter these trades. Now, I always draw out the 5-minute range after London closes. What does that look like? For example, if we were to hop on the 5-minute here, I would be drawing out the first leg that gets created after London, which would be considered this leg here, and I would draw that from wick to wick. What does this give me? This gives me my extension levels. These extension levels should be a pretty good grid line, good marker for where price is going to be drawn to. Now I always draw out the first 5-minute range that London creates. And in Thursday's scenario, it would be this first range on the 5-minute chart. You could see I take the Fibonacci tool up here. And if you need the settings for that, I'll show you it right now. I usually take it from the wick to the wick, and these extension levels tell me where price is headed. Now, I always fib out the first 5-minute range of London after it closes. And in this Thursday scenario, it would be from this wick to this wick. As you could see, that gives us our -1 here at AM lows that you could have caught for about 50 to 100 points. Let me give you some more examples of the first 5-minute range after London closes. So as you could see, we have this range right here that I draw from wick to wick. That gives me my -1 or my rejection point. I could have ended up taking shorts off of this -1, which was also a sweep of this high. I actually ended up taking these shorts. Take that with your 12.5 point stop. Target 50 points for your 1 to 4R, or you could target 100 points for 1 to 8R, and you're good to go. I always take my trades with a 12.5 point stop. On one mini, I'm risking $250, or on two minis, I'm risking $500. Now, this right here to me is an A plus setup. We could see that we drew out the first 5-minute range of London. We get our -1 here at 528. That happens to be right next to London high. So we wait and see how this sweep of London high reacts, and we look for a move lower because the next draw below us would be Asia low. This happened to be an SMT as well. ES did not take out Asia lows, or ES did take out these Asia lows and NQ did not. This to me was a pretty clear A plus setup. You could see that we took out London highs and immediately rejected off of that. But before we get into any more trade examples, I do want to run through the rest of these confluences and things that I look for. And then we'll go over some live trading examples. So we went over the 5-minute range after London. We went over the pre-session manipulation. We could go a little bit more into that. Now, anytime we have a session open, typically we have a manipulation of that session. Typically, we see a manipulation in price before it heads in its true direction. whether it takes out a high before it continues lower or vice versa. So for example, we could see here on this AM session, we had this sweep, this manipulation upwards before continuing lower, in which we almost, so as you could see, we had a sweep here. We had this pre-session manipulation, which I would take my Fibonacci tool and mark out the wick to body. Here we have a perfect example. As you could see, right before New York PM session, we had a sweep up. We had a move upwards, move downwards, and then right as the session opened, we ended up pulling back into this 618 range. This is a pretty A+ mechanical setup. As you could see, this low gets taken out right here. Then I take my Fibonacci tool from the body, not the wick, but the body to the wick. That gives me my 618. You could take your shorts off of that with your 12.5 point stop, targeting 50 points, and you're good. Now, let's say we miss these. Let's say we miss this short. We now have extension levels below us telling us, okay, well, we've got -2 as our reversal spot. So I could take longs off of this, in which you could have caught about 50 points off of -2 on the limit order. But really what I'm interested in here, if this Fibonacci range gets respected, what I'm interested is seeing -4 get taken out or seeing our max expansion. Now, sometimes we won't get the full max expansion. As you could see, -3.25 ended up getting respected here. And it's just more about reacting at that point. Once we see how strong of a reaction we have off of this -3.25, I'm then looking for longs. I ended up catching this on the AMP live account, which was a great trade. Obviously this was news driven, but nonetheless a mechanical W. As you could see, we had price takeout PM low. As you can see, we had price takeout PM low right here. We also had a higher time frame SMT and a 15-second rejection block. And we had our -4. Ended up entering those longs, risking 7.5 points, and that played out to perfection. Now, the final three confluences we're going to be going over, in which I look for, is we have auction market theory. We're going to be going over that, and then our 355 levels, and then the importance of the higher time frame. Now, auction market theory is simple. All the market is doing is trying to find the most fair price to be trading at. It's a market of buyers versus sellers. Now, what does this mean? This just means that there's areas in the market where there's going to be more volume. For example, if you were to pull out in your forecasting folder here, we have what's called the fixed range volume profile. What does this do? This will show me in a fixed range where our point of control or where the most orders on the book are, our value area high and our value area low. Why is this important? This is important because when you have a risk model that calls for a tight stop loss, like a 10, 12, 5, 7 point stop loss, you're going to need to be pretty precise with these entries. Now, going into this trade, we can use our fixed range volume profile tool, and we can mark out the New York PM session. This is going to let us know where our point of control is for what New York PM session is. We had the most buyers and price magneting towards our point of control. As you can see, price broke below our value area low, filling some of these lower. Now, for example, if I were to mark out the fixed range of New York AM session, that will give me where my point of control is, my value area high, and my value area low. When I know we're coming up past the point of our point of control, I know that we have a pretty strong draw below us. Now it's just about finding where your entry is going to be. Now for this example, we're going to use Thursday's AM session. Now, if we were to be marking out the point of the fixed volume profile or fixed range of this volume profile, we could see in this area that our value area high is sitting here at 24,230. We could see on the market or on if you have level 2 data, if you're using book maps or any sort of order flow data like that, that we're seeing some sort of absorption here. Buyers are getting exhausted and we're looking about flipping these and we're looking to flip these longs or flip to shorts. Now, as you can see, we had a wick that swept out this previous high. Now on ES, we ended up creating an SMT as ES did not end up taking out this high. And that gave me some pretty good confirmation using the volume profile tool to understand that, okay, now that we've created a bearish SMT and we've seen absorption, and we have our sweep, we have our mechanical model, and our 618 entry that lies right on top of a 355 level, which we'll go over in a second, that I now have enough confluences to confidently enter this trade. Now, typically, I don't take trades in the New York AM just because of the volatility. I like to trade during Asia, before Asia opens, and pre-market. London is also a really good time period. New York AM is honestly pretty fried, but I ended up taking this anyways, caught my 50 points, and called it a day. Now that we've gone over auction market theory and what that is, let's go over the last and final confluence that I look for. Now that is going to be 355 levels. If you don't know what this is, essentially a 355 level is 5 minutes before the market ends up closing, large institutions and banks have to offload their positions, and it creates a large spike in volume or volatility in certain directions. And this acts as a very good price target or reversal spot or continuation, whatever you may look for. These act as very great key levels. Now, as you can see, if you go to your indicators and you search up 355 levels, it'll automatically map out the candle high and low of the 355 level. And as you can see, that was an additional confluence on this long. If you just add this indicator to your chart and look at what price does off of these levels, you'll often see that price likes to bounce and or continuate off of these levels. For example, we have Wednesday's New York PM session, and we had a 355 level from days back, and you could see that we ended up catching, or you could have ended up catching a continuation off of this range. As you can see, we swept this high, break of this low. We look for our 618. Oh, would you look at that? We wicked right into it. And for additional confirmation, we have a 355 level sitting right on top of where our optimal trade entry would be. And this is an A plus continuation short. As you can see, we have -1 below us, and we ended up seeing a retracement within 5 points of this range. So that's how you know you have a valid Fibonacci. So you can use the Fib tool to catch your continuations. You could use it to catch your reversals and find your -1 point. You could use it to catch so on and so forth. Now you could see that this Fibonacci is still valid. We ended up respecting this range. We had -2.25 below us. You could have limit ordered that. More times than not, when you limit a -2 on a valid fib range that has been respected, more times than not, you'll win. Now, the beauty of having a higher RR, lower win rate model is you can lose 4 trades in a row, hit for 1 trade if you're trading 1 to 4R, and make it all back. It's all about your psychology. Now, as you can see, as this fib range is still being respected, we still have more levels below us. We have -4, we have -3.5, -3.25, and -3 that still need to be taken. As you can see, just about on every single one of these levels, you see some sort of reaction or pullback. -3.25, 24,124, you could see that we had a just about a 80-point pullback on negative 3.25. Negative 3.5, you could have waited for additional confirmation and taken longs off of that. You could have taken it using an inversion, whatever you want to look for on your ICT concepts, whatever. And then you have negative 4 here as well. You could have also taken longs off of negative 4. You probably definitely would have got wicked out there. And then you have your maximum expansion at negative 4.5. That didn't give us anything. So when I pair this all together, what does this look like? In the morning, when I wake up and I hop on the charts and I look on the higher time frame and I understand what is going on. Understanding what's going on the higher time frame is so important. It's going to telegraph exactly what you need to know. And then from knowing what price is going to do on a higher time frame, it's just about you dialing in the exact entry. So what can you do? You can use the Fibonacci tool on even higher time frames. Now, if you think we're going to just have a continuation, you can end up taking your fib from the 4-hour wick, or I'm sorry, 4-hour body to the current wick, and that gives you 50% of your range, or your CE. People call it CE, people call it your whatever. Doesn't really matter. But on new hourly for Jesus Christ, gonna be a lot of editing. Now, as you can see, in certain occasions, you're able to take your Fibonacci tool, and this works on the higher time frame as well. You can end up taking your tool from the wick to the body. That gives you your CE of the candle. CE meaning 50%. It's just a fancy word for your rebalance range, where price leaves the imbalances. As you can see, 50% of your CE on the higher time frame 4-hour wick gives you your 0.5 here at 25,923. Now this is real deal sauce. I would not ignore this. This higher time frame shit is going to be exactly what you need once you get down to become a profitable trader. Simple as that, the higher time frame. Now, you could have taken your shorts for a continuation off of the CE of this 4-hour wick. Some people like to mark out the entire range from wick to wick. Some people mark out the range from the top of a wick. It really just depends on your scenario. So now that we've covered the higher time frame, now that we've covered the mechanical model itself, the 355 levels, how price moves, the higher time frames, auction market theories, everything like that, we have a couple of more key things to go over. Now, true day open. What is this? This is considered midnight open, or where 00 of the day is. As you can see, if you hover over it on TradingView, it says 00 there at the bottom. So that is midnight open, the true day open. True day open is an extremely, I cannot stress this enough, powerful magnet in price. Now, this can be used to catch continuations or reversals. TDO is typically a really, really good target for your pre-market trades, depending on your price action, of course. But anytime, let's say, for example, in Thursday's occasion, we had true day open below us after Asia session. It typically opens every single time at the last candle of Asia. You could see that we go past it a little bit. As you can see, we run bullish for a little bit, and then we get taken back down towards our TDO. This is a super strong magnet for price. Now, as you can see, London session, we had a pretty directional move. We had our manipulation right in the beginning of the session, and then we had our true move downwards. And would you happen to look at that? We end up wicking off of true day open and continuing lower. So now that we've gone over everything that I use and everything that I look for, minus SMTs, you should know what an SMT is. How do we put these all together? Now, going into the market, obviously, I always have my 5 minute range. You can mark it on the 1 minute, doesn't really matter. I have my 5 minute range after London, and I use this to get a good understanding of where price goes. Now, if price does not get respected on this 5 minute range after London, I can find a different leg to anchor my fib to in which price respects. So, like I said, I always have my 5 minute range of London drawn out for me. I go into the day with whatever my bias is going to be. So, for example, this next week, obviously, I'm going to have a pretty bearish bias just based off of how bad we've been bleeding, which means we should see a move up, a gap upwards on Sunday's open. This is being recorded on Saturday, March 28th. It'll probably be up by tomorrow. But with that in mind, I have my bias, I have where my draws are going to be, and I have some potential entry zones. Now, what do I look for? It's all about reacting and not predicting. So if we do see a gap upwards, I'm going to be looking for a sweep of a high or a low. If I'm going to be looking for a gap up, a retracement, and then to catch my longs up to either lunch high, AM high. There's a bunch of these draws. I typically just take it for 50 points and follow the mechanical model itself because oftentimes, especially when we're in a trend that is this strong, we're not going to see the full 100 or 300 point pullback here. Now, depending on how price opens and reacts, if we are bullish, I could use these 355 levels as a additional confluence based on if price comes and respects this. I can enter these longs if it matches up with my OTE, as well as using my fixed range volume profile tool. I can understand where price is at its fair trading point, and then I can look for buying in premium. Then I could look for buying in PD arrays, buying or selling in these PD. Now, understanding what price and discount arrays are in the market is pretty important. It's pretty similar to supply and demand. I made a YouTube video on that previously. I will link the I will put the link for that video up here in the top right corner. And yeah, you could go ahead and give that one a watch. Now, finally, let's just go over some live trade examples. Some more of what exactly I was looking at. And yeah. Now, let's go over this trade, this London short and this Asia long that I ended up catching. That was a beautiful ping pong of the day. I had a pretty good trading week this week. I forget my exact P&L. I'll put it on the screen here in a minute for you. So first things first, we have Asia session. As you could see, we open up and we have this move downwards, and we're sitting on these 355 levels below us. Now, as we can see, we had that crazy news candle that ended up taking out PM high. So the only other draw that I had above us would have been New York lunch high. So once I see that we start to see a little bit of a reversal here on Asia session, I end up marking out the first fib on that and entering off of my 618 here, and that was a good 50 points. Now, how do I end up catching this London short? So as we could see, since this bullish fib range here got respected, now, since this bullish fib range here did end up getting respected, I'm now looking for reactions off of these levels. Now we have our max expansion level right here above us, negative 4.5, sitting here at 23,961. Now, when price comes to this range, didn't exactly respect it to the T, but we could see that we're now getting some sort of a bearish reaction. We also put in SMT here with ES as well. I'll show you that. Actually, we did not put in an SMT. That's my apologies. Um, but as you can see, negative 4.5 in this general vicinity did end up getting respected. So now I then look for bearish confirmation. I now draw out my fib range from the top of this wick to the bottom of this wick, and I'm looking for an entry off of 618, which sits at 23,954. Now, as you can see, 23,954 happened to be the exact high of the night. You could have ended up writing this out for, I believe, like 500 plus points. Now, I stick to my model. I stick to my mechanical model. I trade for 50 points, and I'm out of there. Now, the final thing I'm going to be going over about this video is going to be a little bit behind the psychology of it. Now, setting yourself daily trade expectations and trade rules is going to be extremely important, because if you don't have a goal of what you want to do on the day or what you expect to happen on the day, and you go ahead and you revenge trade and you take more trades than you really wanted to, things go bad. So I like to set a personal daily loss limit of $500 per day, which means I can either risk 2 minis on one trade, or I can take 2 different trades on 1 mini, depending on the setup. Now, I like to do risk adjusted trading based off of my setup and what the account balances are at. Um, I think it's smart to maximize your wins while minimizing your market exposure, because the more you're out of the markets and you're only hopping in to take your piece of the pie and run, the better. I cannot stress enough how many times I've round tripped a 10K plus day because I was greedy and I wanted more. Typically, if you make your money on the day, get off the charts, go enjoy your life, and do something else with your life, and just get away from the charts. That basically covers pretty much the entire trading model that I use and the things that I look for and how I look for them. If you guys have any further questions, I will link my Discord access in my bio. You can go ahead and join that for free. You could ask me any questions. I have a bunch of education in there. I do weekly calls. I do 4 to 5 weekly calls a day with the groups. And I also give out signals on there. So go ahead and check that out. But if you enjoyed watching this and you learned something today, press that subscribe button. Stay tuned for more content. And I will catch you guys in the next video.